Welcome back everyone, and in this video, we're going over 5 of the top stocks to keep your eye on this week. We have some big events coming up, which include earnings reports and Investor Day presentations, and this is a recurring series on the channel where every Sunday we discuss the major events for the upcoming week and take a look at the companies who may be impacted. And one general note to share is that over the past 2 weeks, the tech sector has been hit extremely hard. And if the market continues to downtrend, then we may see some great buying opportunities from some of the companies with amazing fundamentals. So just keep your favorite tech stocks at the top of your watch list for the next few days. And now before we jump into the first company that we're going to discuss in this video, as always, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So once again, please hit that like button, subscribe for the daily videos, and the first company that we're going to go over this week, it is ticker DOCU or Docusign. They currently trade for $204 per share, and of course, over the past 12 months, this company has exploded up 130%. But as of late, with the entire tech sector going down, we can see that from a high point of $265, Docusign is now down over 22%. And all of the young tech companies that were driven higher due to the pandemic are all falling very hard and are approaching much more reasonable valuations. And right now, Docusign's current market cap is at $39 billion. And they're included in this week's video because the company reports earnings on March 11th after market close. We're projecting earnings per share of 22 cents and a revenue estimate of over 407 million. And over the past 90 days, analysts are actually bullish on this latest report, growing their expectations 14 different times. And over the past 4 quarters, Docusign has beaten analyst estimates all 4 times, and over this latest report, we're projecting close to 86% year-over-year growth in their earnings per share. And we can see that going forward throughout 2022 fiscal year, we are projecting some massive earnings growth to continue. So I think Docusign is a company that provides great convenience to the business world, and they're actually one of the few names that I think can remain operational and continue to grow over the long term. And taking a look, they are trusted by some of the largest companies in the world, including Netflix, Salesforce, Apple, Visa, Microsoft, and of course, many more. The company has also posted very strong financial results, and quarter over quarter, total revenue continues to grow at a very fast rate. And taking a look, 95% of their revenue comes from their subscription-based business, which if you've been following along with the channel, you know I'm a big fan of companies who generate revenue with that model. I just love the predictability and the consistency of that revenue coming in each and every month and every quarter over the long term. And their average contract length is at 17 months. And taking a look, they've also done a great job of growing their total customers. They have a CAGR over the past 7 years of 41%, which is absolutely incredible. And at the end of Q3 in their 2021 fiscal year, the company reported 822,000 customers, a massive growth rate over the 590 back in 2020. So overall, Docusign is one of those fast growth companies that exploded due to the pandemic, but as of late is on a massive downtrend. And if you believe this e-document company is going to succeed over the long term and remain a big part of the business world, then definitely over this next week, it'll be a very interesting time to take a look at this company. They report earnings. Other competitors in that field reported a strong fourth quarter, so I think Docusign will come in with similar results, and we may see a rebound in the share price going forward. And now if we move over into stock number 2, we're going to discuss DraftKings, ticker DKNG, currently trading for around $60 per share, and this is the leader in the online sports betting industry. And right now their market cap comes in at just over $23 billion. And like all tech companies, they have seen a slight decline as of late, dropping from a high of over $68 down 13% to where they are right now at around that $60 mark. And DraftKings, I believe, is going to be a long-term leader in this space because of their strong brand and their already mass distribution throughout all of the states where online sports gambling has been legalized. And why we're discussing DraftKings in this week's episode is because the company is hosting their first ever Investor Day presentation while being traded on the public market. And I personally believe that DraftKings investors are going to be very happy after this presentation. the management of this company is fantastic, and they have great plans to unveil new products, new growth expectations, and even a minor acquisition that we have rumors of in the works. So definitely keep your eye on this investor presentation, and I think going forward over this next week, it may shift the momentum in DraftKings stock, sending it much higher than where it is today. And also taking a look at their fourth quarter results, they came in with some massive growth, and they actually raised their guidance for the full 2021 fiscal year, which is a great sign. Over the quarter that ended December 31, 2020, DraftKings reported $322 million of revenue, which was an increase of 146% year over year, which once again is absolutely incredible. And for the 2021 fiscal year, they not only gave guidance, but they raised it off of their previous estimates. Before, they had a range of $750 million to $850 million. But now after this report, they have now bumped that up to between $900 and $1 billion of total revenue throughout the 2021 fiscal year, which represents 40 to 55% year over year growth in their total top line. And DraftKings is the market leader in the online sports gambling space. Right now, the company is live in 12 different states, which is more than any other company in the industry. And these 12 states together represent 25% of the US population, a position that DraftKings has achieved in less than 3 years. And going forward, if you think about it, DraftKings right now, their entire market is only 25% of the total population within the country. As more states continue to legalize online sports gambling, their total addressable market only continues to grow at a very fast rate year over year, and this company has a ton of potential to grow over the long term. And taking a look, we can see right here that total revenue year over year continues to uptrend with over $600 million in the trailing 12 months and projecting close to $1 billion in 2021. And if we take a look at the company's balance sheet, right now they have total current assets of close to $2.2 billion with total current liabilities of only $554 million. So a current ratio close to 4 and very sustainable over the short term. And one thing to note that I really like about this balance sheet is the company currently has no long-term debt, and their total liabilities only come in at $742 million. So a very healthy financial position on DraftKings at this current point in time. So definitely an interesting growth company to take a look at this week. The share price has dropped over 13%, and now might be a great opportunity to buy the dip on the leading online sports betting company. And now we're going to continue on with company number 3, which is ticker JD and JD.com. They currently trade for around $90 per share, and they have grown by 103% over the trailing 12 months. They have a current market cap of $140 billion, and this is one of the largest Chinese e-commerce companies in the world right now. And we all know the e-commerce sector has taken off throughout 2020, and that growth is not expected to slow down anytime soon. And as of late, JD has also seen a nice decline from $106 per share. They are now down over 15%. So if you're looking for exposure to an international brand that's focused in the digital and e-commerce world, then JD is definitely a name to keep your eye on. They report earnings this week as well, before market open on March 11th. We have a revenue estimate of $33.75 billion, with earnings per share coming in at 19 cents. And over the past 90 days, analysts are becoming bearish and have reduced their EPS expectation 11 times with only one single upward revision. But over the past 4 quarters, JD has beaten analyst expectations each and every time, and for this latest quarter, we're expecting 145% year-over-year growth in their EPS. And going forward into 2021, analysts have very high expectations as well for EPS growth in the high double digits every single quarter. And taking a look at the company's income statement, year over year, their total revenue has absolutely exploded with no signs of slowing down. Back in 2015, they only generated shy of $28 billion of total revenue, and in the trailing 12 months have now increased that to over $101 billion, which is absolutely amazing. That growth rate has accelerated year over year, and just taking a look at the chart, they continue to reach record highs. And one thing that's impressive is with their bottom line, they have now reached profitability. Like most growth companies, they had major net losses that improved year over year, and the company now has generated $4.2 billion over the trailing 12 months. And going forward, like Amazon, like many other e-commerce giants, this profitability will continue to increase at greater scale. So JD.com is one of the fastest growing e-commerce names on the market right now, exposure to the Chinese market, and definitely a brand to take a look at because they report earnings this week as well. And now if we move on to company number 4, we're going to take a look at Jinko Solar, ticker JKS. They currently trade for around $42 per share, and of course, just by the company name, we know they have exposure to the solar sector, which is projected to grow at high double-digit rates over the next decade. And right now, this is by far the smallest company on this video with a market cap just at $2 billion, and they're trading with a forward PE of 12.73. And if we take a look at the company's share price chart, we can see that from their high point back in October of 2020 at $87 per share, they have now fallen over 51% to the $42 level. And I think after the massive run-up of the entire clean energy and solar sector back in 2020, they are now falling and approaching much more reasonable current valuations. And we're discussing Jinko Solar in this video because they report earnings this week as well, and we have a revenue estimate of $1.38 billion and earnings per share of 48 cents. And something very important regarding Jinko is that there's a lot of companies right now in the solar space that are burning through billions of dollars every single year. But this company is actually profitable. Taking a look at their income statement, year over year, total revenue continues to grow to a record high of close to $5.2 billion in the trailing 12 months. And if we take a look at their bottom line, net income year over year has been growing as well, with $143 million of total income over the past year. And we can see, since back in 2015, the company has posted consecutive years of profitability, which is a very good sign. And now taking a look at the company's latest investor presentation, they have reported growth in their total market share. And of the top 5 module manufacturers, they now control 65 to 70% of that market, which is absolutely insane. And overall, their total market share has grown from 12% up to 15% in 2020, which is absolutely spectacular. So definitely an interesting company to take a look at in the solar space. They report earnings this week. They're on a massive downtrend as of late. And if you're expecting the long-term success of solar, this may be a cheap company that's actually profitable, trading at a very fair valuation at this current point in time. And now we're going to continue on with the 5th and final company in this video. And we have Verizon, ticker VZ, currently trading for $56 per share. And the company is down just over 2% on the 12-month chart. The big telecom giant that is a consistent part of our lives every single day has a market cap of $230 billion and trading with a forward PE of only 11, so a ton of value at this current level. And Warren Buffett has just bought in an over $8 billion stake in this company, so we definitely see some great success over the long term. And they also pay out a very nice high dividend of 4.5%, which is absolutely incredible with the market that we're in right now at record highs with very low dividend yields. And why we're discussing Verizon today is because the company is hosting their latest Investor Day presentation on March 10th, 2021. And at this event, what investors are really looking forward to is the company's update on their 5G progress. And I think going forward, Verizon is going to continue to be a leader in the space, and I think this report is going to share some very positive results on their 5G networks. And taking a look, as of late, this company continues to grow their operations each and every year. Of course, their net income does fluctuate depending on the repairs and the expenses to their business, but overall, if we take a look at the cash flow statement, their total cash flow from operations, or the cash they generate from conducting their everyday business activities, has been growing each and every year over the past 5 years, and now sits at over $41.7 billion, which is absolutely incredible. So for companies, net income can fluctuate year over year, but cash flow from operations is a great metric to see if the company is actually expanding their core business, and it's clearly evident that Verizon is doing just that. And if we take a look at the company's current dividend, with that yield of 4.5%, it only makes up 50% of their total net income, so it is very sustainable over the long term. And right now, they don't increase that payment very much, averaging only 2% annual dividend growth, which of course is on the very low side. But if you're in there for the income and you actually use those quarterly payments to pay bills and live your life, than collecting such a high yield with a very safe and sustainable dividend that is going to grow to match inflation. That is a very nice sign at least. So definitely take a look at Verizon. Their latest Investor Day presentation comes up this week. They're going to share their 5G update, a company that continues to expand their operations year over year, and a very nice high dividend paying stock that I personally own in my portfolio as well. And now we're going to wrap up this video, everyone. So I want to thank you for watching to the end. If you're new to the channel, please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market. So join the community. Please leave me a comment down below, share any questions, discuss this company or any of the ones we mentioned in this video. I appreciate the support, and I will see you in tomorrow's episode.